France is one of the richest and most developed countries in the world, known for its high quality of life, strong social systems, and generous welfare benefits, but behind this image of stability lies a growing economic tension that has sparked protests, political debates, and nationwide disruption. Because at the center of this issue is something that was once considered a symbol of security: pensions, and what was designed to protect people in old age is now becoming one of the biggest economic challenges the country faces. And the question is not just about retirement, but about whether the system itself is still sustainable in a rapidly changing world. Because for decades, France built one of the most generous pension systems in the world, where workers could retire relatively early and receive stable income supported by the government, and this system was based on a simple idea. Current workers pay into the system, and that money is used to fund retirees, which works well when there are many workers supporting fewer retirees. But over time, this balance has started to shift dramatically because France, like many developed countries, is experiencing an aging population, where people are living longer and birth rates are declining, which means fewer workers are available to support a growing number of retirees. And this creates a financial imbalance, where the system is paying out more than it is receiving. To cover this gap, the government must either increase taxes, raise retirement ages, reduce benefits, or take on more debt, and each of these options comes with serious economic and political consequences, because increasing taxes can slow economic growth, raising retirement age is unpopular and leads to protests, reducing benefits affects living standards, and increasing debt can create long-term financial risks, and this is exactly the dilemma France is facing today. As attempts to reform the pension system have triggered massive public backlash, with people taking to the streets, protesting changes that they believe threaten their future security, and this highlights a deeper issue, because pensions are not just an economic policy, they are a social contract between the government and its citizens, and any change to that contract can create strong emotional and political reactions, and at the same time, the economic pressure continues to build, because as the workforce shrinks and the number of retirees grows, the cost of maintaining the system increases significantly, which puts strain on government budgets and limits the ability to invest in other areas such as infrastructure, education, and innovation. And this can have long-term effects on economic growth, competitiveness, and overall stability. And another important factor is France's labor market, which has traditionally been more rigid compared to other economies with strong worker protections, high taxes, and regulations that can make it more difficult for businesses to hire and expand. And while these protections provide security, they can also limit flexibility and economic dynamism, which makes it harder to adapt to changing conditions and generate the growth needed to support large public spending programs like pensions. And this creates a complex situation where the very systems designed to provide stability may also be contributing to long-term economic challenges. And as global competition increases and economies evolve, France must find a way to balance social protection with economic efficiency and sustainability. And this is not an easy task, because it requires structural reforms, policy adjustments, and public acceptance all at the same time. And this is where the real question emerges. Has France built a system that is too generous to sustain, or is it a model worth preserving, even if it comes at an economic cost? And this is where the real story begins. But what makes France's pension crisis even more complex is that there is no simple solution, because every possible fix creates new problems. And this is why the situation has become so politically sensitive and economically challenging, because if the government decides to raise the retirement age, which is one of the most common solutions, it immediately faces massive public resistance, as people feel that they are being forced to work longer for benefits they were promised earlier. And this is exactly what has triggered widespread protests across France, where millions of people have taken to the streets to oppose pension reforms, showing how deeply this issue affects society and trust in government. And at the same time, if the government chooses to increase taxes to fund the pension system, it risks slowing down economic growth, because higher taxes can reduce business investment, discourage entrepreneurship, and lower overall productivity, which can weaken the economy in the long run. And if instead the government decides to reduce pension benefits, it directly impacts retirees who depend on this income for their daily living, which can increase inequality and reduce quality of life, especially for lower income groups. And finally, if the government chooses to take on more debt to cover the shortfall, it may provide temporary relief, but creates long-term financial risks, as rising debt levels can lead to higher interest payments, reduced fiscal flexibility, and potential economic instability in the future. And this is the core dilemma of the pension system, where every option involves trade-offs that affect different parts of the economy and society. And this is why the problem is not just about numbers, but about priorities, choices, and the kind of economic model a country wants to follow, because France has historically chosen a model that prioritizes social protection, equality, and quality of life over pure economic efficiency. And while this has created a high standard of living, it also requires strong and sustainable economic growth to support it. And this is where the challenge becomes more structural, because maintaining generous welfare systems in a globalized and competitive economy requires constant adaptation, innovation, and productivity improvements. And without these factors, the financial burden of such systems becomes increasingly difficult to manage over time. And this is why economists often argue that long-term solutions must focus not only on adjusting the pension system, but also on strengthening the overall economy by increasing workforce participation, encouraging innovation, improving productivity, and attracting investment. And one of the key areas of focus is labor market reform, because increasing employment, especially among younger and older workers, can help expand the base of contributors to the pension system and reduce the financial pressure. And this may involve policies that encourage hiring, reduce barriers to employment, and support flexible work arrangements, which can make it easier for people to remain in the workforce longer. And at the same time, investing in education, technology, and infrastructure can help boost productivity, allowing the economy to generate more output with the same or even fewer workers, which can support higher tax revenues without increasing tax rates. And this is particularly important in the context of an aging population, where the number of workers is not expected to grow significantly, and therefore productivity gains become essential for sustaining economic growth and social programs. And another important factor is immigration, which can